This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. So today we really talked about the name and introduction of the podcast. We talked about rational decision-making and feelings and financial decisions. But we talked a lot about feelings, not our own feelings.
The name of the podcast was deliberate. It was to be that rational reminder of what you should know when you're making decisions. We've had so many cases lately where people are making decisions explicitly based on how they feel.
Yeah. So today we tried to cover off just the role of feelings in decision-making and financial decision-making. We kind of touched on like what is a good decision, because it's not necessarily going to be the rational decision.
Nor the best decision.
Yeah.
But probably isn't going to be rational. Most people don't make rational decisions. Most people make emotional decisions, then justify it with rational thinking after the fact.
Right. Which by definition is flawed rationale.
Right.
Yeah. Anyway, so we talked about that. We talked about a couple of podcast housekeeping items and one story from out on the web. Yeah, anyway, so you had a good weekend? You were away?
I was away for a few days up to a resort near Whitney, Ontario, right on the edge of Algonquin Park. Amazing, beautiful weather, beautiful country. Went through a great hike in the park. Never been there before.
I've never been either.
It's stunning area and close to Ottawa, so it was super fun. And then heading to Australia next week.
Pretty cool.
Yeah, so going to the Dimensional Global Conference, which first time I've been, and I've been invited to participate in a panel on using social media in the client experience. So we'll talk about your YouTube channel, which has huge traction, and our podcast, which is growing every week. How to do it, how to implement it, what the results have been like.
Yeah. And that just made me think of something that I wanted to say in the episode, but forgot. So here we are. If you're listening to the podcast and you enjoy it, rating it on iTunes is great. But if you share it with somebody that you think would find the information useful, that would be very much appreciated by us.
Yeah, because we're not promoting this anywhere. This is solely an organic source of hopefully valuable information.
But the more people that listen, I find we get really interesting feedback. And the larger we grow the audience, the better I imagine that will get.
100% agree.
All right.
There you go. Have a listen.
Welcome to episode 38 of the Rational Reminder Podcast. If you're new to the podcast, we know we've been getting a fair amount of new listeners. Cameron and I, the hosts here, we're portfolio managers at PWL Capital in Ottawa, and we use the podcast to talk about all kinds of personal finance related stuff, but definitely a focus on, I guess, investing in portfolio management, because that's kind of where our heads are most of the time. But we do try to keep a pretty balanced range of topics.
And some stories from the front when we can share them. And
we try to have it, we don't try, we have a guest every other episode. So we alternate between us talking to each other and having a subject matter expert as a guest.
And I think this tempo was working. I think it's a good mix of the two. Perhaps we went a little heavy on the investing for a while, but I think we had stuff we had to get covered off.
Yeah.
But now that we're into the tempo and the model portfolio has been built and some really good guests have been on and are lined up to come on.
Yeah. So on today's episode, we want to talk about something that comes up for Cameron and I mean, every day, really. And it's feelings, which may sound kind of funny.
Especially if you know us.
Yeah, we're not going to talk about each other's feelings. We don't talk about that much.
But it comes up a lot, and it's come up a lot lately, very specifically that feelings are driving decisions.
Yeah, I mean, people say it all the time. I feel like this is a good decision, or I feel like we shouldn't do this, or we should do that. And it's a really hard problem to tackle because we, in our role, like to try and help people make decisions that are rational or logical. But if that doesn't feel like a good decision, it might end up being a bad decision, even if it is rational.
Because
if you make a rational decision, you're not always going to get the expected outcome.
Yeah.
And if people feel bad about making a rational decision and then don't get the good outcome,
then they just question their judgment again.
Well, they question their judgment, but they feel bad. They feel really bad.
And often feelings can really motivate people. So if you feel something is better, that can really drive your motivation to execute on that plan of action.
Yeah. So we're going to talk about feelings, but before we get there, before we get into it deep, we want to talk about a couple of other things couple of housekeeping items from the podcast, one story, and then we'll get into our main topic. So a few episodes ago, we talked about the safe savings rate, which is really interesting research. And we were pretty excited about it when we talked about it. And we said that we were going to take some time and go and dig into it and see if it's something that we can actually implement. And the answer to that question ended up being a pretty hard no.
Yeah, it's a tough nut to crack, just not enough data, right?
The problem is the data. I mean, the research is based on U.S. stock data going back to 1871. The problem is when we're talking about safe savings rate, we're talking about modeling a 30-year saving period, or well, in the example that we were talking about in the podcast last time, a 30-year period of saving, and then a 30-year period of spending. So 60 years. And in reality, that probably isn't even long enough. But for a 60-year period going back to 1871, we have two full sets of non-overlapping data. So two periods, which isn't a lot.
Right.
And then you start going, what other data is out there? You start looking for global data, which exists going back to 1900, but we've got the same problem. Just barely two non-overlapping 60-year periods. And again, 60 years probably isn't even long enough for a real person.
And do you think it matters that the markets have changed over time very much? Like how much would that impact the data?
Well, that's the problem. We don't know. This is the problem. Safe savings rate it is based on the assumption that stock returns will revert to the mean.
Correct.
So if you save through a period of higher than, high returns, you should expect lower returns for your spending period, which affects the amount that you should.
Which means you had to save less while the market's doing well, and your withdrawal rate on the back end had to be lower.
Right. So the whole thing is decoupling how much you have in assets from how much you need to save. But that's based on the assumption that if you have higher assets than you maybe would have expected to have, you should expect lower returns going forward.
But there's not enough data to suggest that there is expected mean reversion.
Well, the data that we have shows that that has happened. But the problem is we only have two non-overlapping periods. So the solution to that, when we're talking about financial planning research, is always bootstrap. So instead of taking the time periods that we have from real historical data, you take all of the data for those time periods, take the monthly returns, and you create your own set of data, which you have control over the time period. We could make as many 60-year periods as we wanted to with bootstrap, just taking each month from a historical return and then putting it back in the data set to recreate a 60-year period. The problem for safe savings rate with bootstrap is that you completely eliminate any trend.
Exactly.
Like that idea that if stock returns have been high, they're going to be lower. If they have been low, they're going to be high going forward. That goes away completely with bootstrap.
For sure.
Now,
it makes it more normal.
Well, yeah, there's no serial correlation in the data. When you read the financial market research, especially from guys like Fama and French, they believe that there should not be any serial correlation modeled when you're looking at stock returns. So if you ask them, they would say that bootstrap is fine, even though it destroys serial correlation. But in any case, the only way we can get enough data to use something like safe savings rate is through bootstrap, and bootstrap destroys the thing that makes safe savings rate work.
Right. So what's the key takeaway then? Just to be aware of what your savings rate is, which, as we said on the podcast, many people don't even know that for themselves.
Yeah. I mean, I think in practice, we sort of do. It's pretty interesting, actually. We kind of do take the safe savings rate type idea into account just based on the way that we do our expected returns for financial planning. Because we adjust our expected returns every 6 months, and our expected return assumptions are affected by current price earnings. If current price earnings are high, we lower our expected returns.
Yeah, it's not predictive. It's just adjusting the model to reflect what has happened.
Correct. So in a way,
which affects savings rate as you update the plan every time.
Correct. Which is kind of similar, I guess, except not really. No, we're adjusting it more frequently. Safe savings rate would have you not adjust ever based on the few historical trends that we have to follow. Anyway, so safe savings rate's hard to say. It's really a neat idea, and behaviorally, I really, really liked it. But in practice, when we started digging into how comfortable would we be basing actual financial decisions on it, not so much. I had a quote from Eugene Fama that kind of summarizes why. But remember, this is all based on mean reversion for safe savings rate to work. And Fama said something along the lines of, stock returns may be mean reverting, but we don't know what the mean is, and we don't know when the reversion will happen. So even if they are mean reverting, like even if we assume that they will go up if they've been low, stock returns, you don't know when they're going to go up. And if it doesn't happen at the right time for your retirement, well, you're going to run out of money. So I guess that was we were pretty excited with this last time. This is like the academic, the equivalent of a retraction.
That's good information for people to have and to know we thought it through.
Yeah.
So let's talk about the ETF model portfolios. I know you had someone reach out to you wondering where they were online if they wanted to go build it on their own.
Yeah. So we have the paper. I've reviewed the first draft and I had to make a couple of edits, but I'm hoping it's out this week and that'll be on the PWL Capital website. And once it's up, we can also put it in the notes for this episode of the podcast. And then the model portfolios, so separate from the paper where we introduce the portfolios, and then the PDF, just like we have for the model portfolios on our PWL site. We're going to post Rational Reminder model portfolios on rationalreminder.ca, which is our website for the podcast. So that's hopefully this week, those will go up.
But it's worth mentioning that these aren't portfolios that we use normally with our clients.
Yeah, I had that question from somebody. Yes, we are not implementing these at all whatsoever. This is our attempt to create something that a do-it-yourself investor who cannot access dimensional funds to allow them to build something that at least has factor exposure. So that's all this is. We're not using these for clients. If people want to use them to kind of implement the type of stuff that we talk about on the podcast, then I think that's great. But yeah, to be very clear, we're not changing what we do. We still believe that dimensional is the best thing for our clients.
Or they could use it as their own benchmark too, if they wanted to, what a factor tilted portfolio returns might look like.
Sure.
So did you see the article that Michael Batnick had up?
Yeah, it was hard to miss it. It was everywhere.
Man, he gets a lot of activity on his post, but he wrote the 20 craziest investing facts ever.
And you picked 5 of them that you like the most.
Hopefully you agree. I don't know if you went through the whole list or not, but I thought they're pretty good.
Well, read them out. They are good.
So get this, the Dow index has spent more time, 40% or more below the highs than within 2% of the highs.
Wow.
Absolutely staggering to me that it was that long below the highs over a long period of time.
That one surprised me, actually.
U.S. 1-month T-bills went 68 years with a negative real return.
Unreal. So
that's when you knock off inflation. Gold and the Dow were both 800 level in 1980. Today, gold is $1,300 an ounce, and the Dow is near 26,000.
Wow.
If you had invested from 1960 to 1980 in those 20 years and had beaten the market by 5% each year, you would have less money than if you had invested 20 years again from 1980 to 2000 and had underperformed the market by 5% a year.
That one's wild.
That just blow you away. Just when you were born and when you started investing mattered more than how well you did relative to the market. And get this one, 47%, only 47% of stocks generated a lifetime return that match 1-month T-bills.
That one's good, but there's an even crazier stat along those lines. It's that from 1926 through 2016 or 17, 4% of the stocks in the U.S. were responsible for 100% of the return in excess of T-bills.
Gosh.
And that just speaks to, and I think Michael noted this in his post too, that just speaks to the distribution of stock returns and why it's so hard to beat the market. Because if you don't get those tiny few that drive most of the market's performance, you're going to underperform.
And the active managers say the opposite. If you avoid the ones that really are so bad and just pick the ones that do well, you're going to blow the index out of the water. Well, the data just doesn't.
If you could do that, of course that's true. But you can't.
But that's the perpetual appeal of it.
I'd love to, I don't even know how you'd measure this, but I'd love to see like those few stocks that drive most of the market's return. I'd love to see the, media coverage or the sentiment around those stocks. Like were those popular stocks, were those companies that people thought were going to drive the returns of the market?
Yeah, I remember seeing one article, I forget when, but comparing Apple to, I think it was Clorox. And at some period of time where Apple did so well, and they said, yeah, but had you bought Clorox, you would have done so much better. This is a while ago. But there's always stats like that.
I've seen one like that. I think Netflix or Domino's beat Netflix over the last, 5 years or something.
Okay, so we're going to talk about your feelings now.
Yeah. So like we mentioned at the start, feelings come up for Cameron and I all the time. We spend a lot of time helping people make decisions. But like we said earlier, decisions, they can't just be good. Well, I guess it raises the question of what is a good decision? Is a good decision a rational decision, or is it a decision that feels good, or is it some combination? And we're talking about people's money. Like this stuff is, we interviewed, this one's not live yet, but the neuro
Dr. Moira Summers.
And she called money some fascinating term. It was like your financial lifeblood, or your,
Yeah,
do you remember what she called it?
I forget the term also.
Yeah. The point is money is obviously very important to people, and it is. It's an expression of work that you've put in and decisions that you've made. Anyway, so when we're talking about decisions around money, people rightly do get very emotional. So from our perspective, one of the challenges is that even though we may know what a rational decision is or a logical decision is, that's not always going to be the right decision for someone to make.
Yeah, we're not talking about like active versus passive necessarily. We're just talking about feeling decisions, like some of the examples we've heard just in the past few weeks. I feel that owning investment properties is real, whereas owning stocks and bonds is not real. It's like this digital...
And therefore not safe.
Therefore not safe. It's like, I can see how people might feel that way because you can go touch your building, but the data does not support that at all.
Well, it's not even about the data. It's just about property rights, right? Someone can take the title to your home just as easily as they can take your ownership of the security.
They can't go and drag away the building, right? Whereas I own this stock of pick whatever company I own, this index. I don't really know what it is. I see the code and I see what's not on my statements, but
you start talking about property rights. I mean, it gets pretty interesting pretty quickly because you have a piece of paper that says you own a home or a building or whatever, but that only exists because of the laws that we have in Canada or whatever country you're in.
Or about the classic one we get all the time. I feel that dividend-paying stocks are the most sensible investment. I like to get paid to own the stock.
And there's tons of data to refute that. We did a video on YouTube that's gotten a lot of views and some good discussion there. But yeah, it's the same kind of thing.
And people will say, yes, Ben, you're right, but I feel it's better now. There's a better time for it.
Some people say that. The dividend one, people are less inclined to say that it's not logical to invest in dividend stocks. But anyway, people will often say things like they feel like they're safer investing with one of the big banks. But of course, everybody's covered by CIPF. Everybody's IROC regulated. So it doesn't make a difference. And the challenge with a lot of these decisions...
But it's the bank. What could go wrong with the bank?
Yeah.
I feel it's the safest place to be.
But you start picking through these things and it's like, okay, well, the banks, they actually have a conflict of interest where their fiduciary duty is to their shareholders first. And then with investment properties, it's like, okay, sure, you feel good about it, but you're massively under-diversified and you can't possibly diversify enough to make it a statistically reliable investment. But this is the challenge. We know what the data show, but that's not always easy to communicate to humans. And I think some of the main biases that we bump up against are confirmation bias.
But this is rampant everywhere in society now. There's so much information that people are quasi-addicted, I think, to information that validates their already held beliefs.
Which plays
This is not just in investing. This is everywhere.
Sure.
I mean, look at what happened in the U.S. election. Look what happens on all kinds of different topics.
And it plays into overconfidence bias, but then we've also got regret aversion, hindsight bias, familiarity, self-attribution, endowment, and that's just a small list. But I think people end up making decisions based on how they feel and then looking for the rationale to justify the decision that felt good.
Of course.
And there's some research from the University of Chicago that you sent me on that people make snap decisions despite having tons of information and despite feeling like they would make a rational decision. People will make snap decisions and then it's really hard for them to change their minds once they've made that decision.
But this is a good trait to have as humans because we have to make so many decisions all day long. So this is a very good trait to have. Just unfortunately, in many cases, it's not a great trait to have because it's hard to understand the rationale to go and change your mind. And most people don't want to change their mind.
Yeah.
It's a lot easier to keep your beliefs and keep reading information. And we may be guilty of this as well. Keep reading information. We do our best to try to consider active strategies and other different things that come along.
I don't know if we try to consider them. We read about them. I've never considered one.
Well, you haven't. If you found one that was compelling enough, you would.
Yeah.
For sure you would.
Yeah, of course.
You have to.
Of course.
But it's to be aware of that bias. And most people are not even aware of it.
Yeah.
Because you have no time. I mean, everyone's so busy now and we're all flooded with information on our smartphones. This goes back to Daniel Kahneman's book, Thinking Fast and Slow, the two systems. System one, thinking, which is the quick, reactive, 2 + 2, you know the number right away. Whereas you say 17 times 24, you have to pause and kind of get close, but it makes your brain work too hard. Well, that's too hard. Why would you do that? I think we face the same thing a lot when people come in here wondering about investment philosophies. And that's why we decided a long time ago, we're not here to change people's minds about how they invest.
No,
because you
not a
can't.
chance.
Most people won't change their mind.
Yeah. So we both listened to Sam Harris, did a live show with Danny Kahneman in New York and posted the audio as a podcast episode on his Making Sense podcast. It was a good interview or discussion. So Kahneman, I don't think he needs introduction. As Sam Harris said this in the podcast too, he's the only guest he's ever had that really doesn't need an introduction. But he's the father of modern decision-making thinking and our understanding of how humans make decisions.
Brilliant. It was a brilliant interview.
He had some really interesting, and I love the way Sam Harris asks questions. He doesn't say, tell me about this. He says, how do you think about this? He's not asking for facts. He's like, how do you think about this topic? I thought that was great. Anyway, so Kahneman said, one of the things Kahneman said that I really liked was, and this may be paraphrasing, I was taking notes while I was going for a walk. The correlation between confidence and accuracy is not high. Intuition is not always a good thing. And that's so relevant when we're talking about financial decisions and investing in general, because people have, it's the things we were just talking about. People intuitively believe that dividend-paying stocks are better investments.
Yeah.
And they have that intuition and they make real decisions based on that intuition. But the problem with intuition is that it's not always right. In fact, in a lot of cases, it's wrong.
And the markets can't go up forever. Well, we got 10 years now. There must be a correction coming.
Yeah. All that same kind of thinking.
Yeah. I mean, it leads to also when you go to choose an investment, right? Like it also, you could see people wanting to buy an active mutual fund. Right. It must make sense that you're smart. You have a CFA. You do research all day. You must be able to beat the market. That's why you do what you do, isn't it? So why can't you go find me people like that? Yeah.
And that plays into one of the, Kahneman actually said this is his favorite bias when Sam Harris asked him what his favorite one. He said, it's like, what do you call it? Picking the favorite of your ugly children or something.
That's it.
Yeah. But Kahneman said that his favorite one is non-regressive prediction, which he described as drawing strong conclusions from weak evidence. And so when we're talking about what you're just saying, Cameron, if you find an actively managed fund or a hedge fund or a stock picker or whatever it is that has done really well, we're inclined to believe that means that they're skilled and that they're going to do well in the future. Even though we've got this tiny, tiny little piece of evidence that this one person's done well, meaning that they're potentially skilled, and this huge weight of evidence showing that past performance does not indicate skill in most cases.
I can remember when that light went off for me back in 97, 98, having a debate with a colleague, and I was kind of the last man standing believing in active management in the office. And that's when the light went off. He said, but those returns could have been luck. You have to let go of your belief and just realize that could have been luck. And it kind of all changed right then.
Yeah.
But I can remember hanging on to my feelings. I felt that this was a good manager, was a good global manager, great reputation. And sure enough, I mean, I'd made the switch, but soon after the returns imploded, they left Canada. It was just a complete mess.
Jeez, wow. That non-regressive prediction also made me think of factor premiums. Like we talk about small cap and value a lot. Small cap and value have underperformed for say 10 years in the US anyway. But again, that's a tiny little piece of evidence, 10 years, relative to the massive weight of evidence that we have for all of history and all around the world.
And the returns are not unexpected. What the experience we just had over the past decade is not unexpected. Unfortunately, when you don't have that rational reminder that this is what can happen,
right?
You get no anchoring to your feelings. Oh, well, value stocks are terrible. Not owning value stocks again. I'm going to go back to my great Canadian dividend paying stocks because they never let me down.
Right.
But you don't have the full view of all the data.
Well, that's what Ken French, we saw, did a talk a few years ago on Bayesian thinking, which is probability updating. But it's basically, I guess the simplest way I can think to explain it is taking the new information and updating your existing beliefs with the new information, but taking into account the weight of the existing information and the weight of the new information. So if you have many, many years of data that clearly show stocks outperform bonds, and you've got 10 years where stocks don't outperform bonds, the weight of the new evidence is very small.
Right.
And you're not going to change your expectation.
And probably even stronger if you live through it as an investor.
That's one
like your own experience will drive it even more.
Yeah. Yeah, that's one of the articles that you sent me talked about that too.
Well, Daniel Kahneman talked about that in doing interviews.
Yeah, okay.
He said people in face-to-face, when you experience meeting someone face-to-face, you put way more weight in that as part of your total decision to hire that person than is justified.
Right. Yeah, and your own experiences in general. They talked about scientists and how they'll put more weight on their own results than they will on other people's results. You can think about that as investors too. If someone's had success picking stocks, say for their whole life, they're never going to become an index investor.
Well, I just had an interesting conversation on that. So someone I've been speaking to lately was in business and knew how they could control success in their business. And the biggest learning he's had to change is you can't control what stocks will do, but you can control your portfolio now. So as opposed to trying to control and manage it to beat the market, the realization is now that, no, I have to control the structure of my portfolio and kind of let go of all that control and trying to beat the market. That
shows up a ton in the family office research that we pay attention to. They talk about that a lot. Where of course, if someone's had success in business and they've built something that they were able to sell for a meaningful amount, of course they felt like they had control, and they probably did have control. And that they hope extends to investing. But the reality is, it doesn't, just because of the way public financial markets work.
And even controlling risk profiles. So even how you present risk to a client will drive their asset allocation.
That applies to tons of different decisions.
But I just think about that when you're with someone. If you talk about the chance of the downside loss, for example, in 2008, an alt equity portfolio might have been down 35 to 45%. If you present it that way, as opposed to over long periods of time, it outperformed by whatever, 1, 2, 3, 4% a year. If you focus on the downside, you will end up with a more conservative portfolio.
Yeah.
And I can tell you, people were much more risk averse in early 2009 after the horrible market than they were beforehand.
Kahneman talked about that. He talked about the importance of framing. And part of the discussion was, if you're in a position to influence someone's decision, they were talking about physicians, but I mean, it applies to us as well, where we know based on data what the rational decision for someone to make is, but we also know that they're going to make the decision that feels good. So Sam Harris was asking Kahneman, how do you help someone make a decision that's the right decision? And Kahneman said, well, it's all about the framing, which is fascinating to think about that, because that puts us in a position to frame decisions in a way that are going to influence the outcome, which is kind of scary. But one of my favorite examples, I think, in practice is if someone has a concentrated position in a stock. So maybe they inherited it, maybe it's a stock option type situation, whatever it is, but they've got this concentrated position in one stock. And there's a bias called the endowment bias, where humans they'll place more value on something that they already own.
For sure.
I think regret aversion plays into this too, where you're concerned if you sell this thing that you currently own,
you've held on for so long,
and if you sell it, you're gonna regret.
Miss that gain.
Right. So I always try and flip the framing and ask the person that I'm speaking with to flip around and think about, say it's $1 million in stock. What if that were cash? And then think about all these financial goals that you have. You want to start a business in a couple of years. You want to retire at whatever age. Kids going to university. All these different priorities. If you had $1 million in cash as opposed to in this stock, would you invest all of it in the stock? And not once has someone answered the question as, yes, I would invest all of it in the stock. Not once. But it's just flipping the framing.
Or we've also framed it in terms of, if you get another, whatever, $5, $10, $20 on that stock before you sell, what does it do to the success of your retirement plan?
Right.
And the success, it might be a few $100,000 of absolute capital if it does go up, but your plan success might go from 92 to 94%. It's not material in total scheme of economic freedom.
Right. So it's framing it in terms of marginal utility. How much marginal utility do you get from an additional, say your stock doubles from $1 million to $2 million? If you're already able to retire with the $1 million, how much utility do you gain from having it double versus maybe if it goes to zero, you can no longer meet the retirement goal.
So you talked about you read a book called Decisive.
Yeah.
I have not read it yet.
I read it a while ago.
I just thought some of the points that you had were super interesting.
Yeah. So they kind of break down the ways to get around the 4 things that make decision-making really hard, which are a lot of the things that we've been talking about. The authors of this book suggest that you do 4 things. Widen your options. So that's thinking about, are there options that you haven't even thought of yet?
So how would that apply in our world? Someone coming in.
Geez, I don't know.
Like retire later, save more. Is that the kind of thing?
Yeah, those are easy ones. Maybe if they're thinking about selling their house, maybe adding in the option of, what if you do a reverse mortgage? What if you, instead of downsizing, sell to rent? I guess those are...
Move to a cheaper location.
Yeah. Those are just off the cuff examples, but that applies to any situation where if you're thinking about 3 different options, there may be a 4th one that you haven't thought of. Well, there's probably almost always going to be some alternative. The next one is to reality test your assumptions, which kind of means finding the data. Like if you're holding onto a stock because you feel like it's going to do really well, what if you go and look at the data on how individual stocks tend to do, which we talked about earlier, and it's not very good, but that may affect the decision.
Or even to understand what a reasonable expectation for return is.
Right.
So many people said, I want to make 10%.
Right.
Based on what?
The third one is to attain distance before deciding, which basically means getting clear of your emotions, which obviously, as we've been talking about, they can play a really big role in decision making. Attaining distance may involve getting an outside view from a trusted source or an expert or something like that. And then the last one is to prepare to be wrong. I love that one. And I know we're not supposed to talk about dimensional, but they always say that not supposed to. It's our podcast. I can talk about whatever I want. Dimensional always says that if small cap and value don't work out, the result's still going to be pretty good because they own the whole entire market.
And I remember this debate I had with a reasonably high profile forecaster who was promoting a very concentrated portfolio in a hedge fund and in gold.
Wow.
With great passion. This has got to be, 15 years ago. And I said, what if you're wrong?
Yeah.
And he hadn't even considered that as an option. What do you mean, what if I'm wrong?
Wow.
I'm like, what if you're wrong? And the hedge fund had, what was the percentage in one stock? It was in one crazy oil stock. And then shortly after the manager quit the fund shut down. I don't know if people got their money back. I assume they did. And gold has not been great, but I'm sure it's not been a good experience.
Right. Yeah. That's an interesting one. That kind of plays into what we were talking about with the marginal utility on either side of the decision. If you keep your individual stock and it doubles, what do you gain? But if it goes to zero, what do you lose in terms of lifestyle? So prepare to be wrong. What happens if you don't get the outcome that you were expecting? But you know what? That applies whether you're making a rational decision or not. Because even if you make a rational decision, that's one of the hardest things about rational decision making is that you might not get the outcome that you wanted. There's a reasonable chance you won't get the expected outcome.
Right. But we know people are wired to use less information than they think to make up their minds. That's the way we are. And once we've made up our minds, we just go with it. And in our world, truthfully, it's good for the business because a lot of people come in and a lot of it's based on trust. They don't even know how to do due diligence. Most people aren't trained in this at all. So what do you expect people to do?
Right. I think more and more of the people that we see are coming in after having listened to the podcast or after having watched the YouTube videos. And so they have an idea regarding this type of due diligence that they should be thinking about. Anyway, so feelings are very important in decision-making and particularly, well, maybe not particularly, but definitely important in investing and personal finance because every day there are decisions to be made about all sorts of things. And we would love to think that we can help everyone make a rational decision, but the problem is that the rational decision is not always going to be the right one. In a lot of cases, people are very comfortable making an irrational decision based on how they feel. And there's nothing that we can say to fix that.
Correct.
Other than changing the framing, maybe.
Perhaps.
All right, anything else?
No, that was good. Interesting.
Okay.